Okay, so we have now switched from current liabilities to non-current liability. And first up, we're talking about the different types of bonds. We mentioned bonds can be secured or unsecured. You have what's called convertible bonds as well as callable bonds. So let's continue our discussion on different types of bonds. So when you purchase a bond, you receive what's called a bond certificate. Issued to an investor. It gives you the company name, the bond's face value, maturity date, and what's called the contractual or the stated interest rate. And we'll take a look at a bond in a few minutes. You can see the information on the bond certificate. What's face value? Face value is the principal due at maturity. So if a bond, say, matures in 5 years, the face value is the amount you're going to receive at the end of that 5 year period. Maturity date is the date the final payment is due. So if a bond is a 5 year bond that's issued, say, in 2020, that bond will mature in 2025. Contractual interest rate, is also referred to as the stated interest rate. That's the rate written on the actual bond contract. So the rate may be 1%, 2%, 3%. That rate indicates the amount you receive in interest as being the actual bond holder. Because did you all know that certain type of bonds paid interest? Yes, they do. So as a bond holder, you'll see in a few minutes, you receive interest payments along with the bond's face value when their bond actually matures. So here we have a sample of a bond. This bond has a principal or face value of $5,000. The interest rate is 5.75%. It shows the actual bond's issuer. It has maturity date of May 1st, 2021. And then at 5.75% is the contractual interest rate. The bond has a face or par value, which is also the same as the principal value, in the amount of $5,000. So here it was issued by the International Minerals and Chemical Corporation. So if you bought this bond, you received the $5,000 plus interest each year from this company over a 5 year period. Okay? Determine the actual market price of bonds. So put on your thinking cap so you can understand this concept. All right? So there's a market for issuing bonds, the same like you have a market for issuing stocks. And bonds are going to be rated. There are companies that actually rate bonds. Depending upon the company issuing the bonds and how stable they are financially. So think about school. Bonds get grades just like students, and the grades go from A to F. Of course, A being the highest grade, F being the lowest grade. If a company is stable financially, they'll be more on the higher side. But if that company is unstable financially, or maybe in the past they defaulted on paying a bond holder, they'll receive a lower grade such as a D or an F. And I'll discuss why that's important in a few minutes. So determine the current market price of a bond's present value. We look at three factors. The dollar amount to be received, the length of time until the amounts are received, and the market rate of interest. Again, the dollar amount to be received, the length of time until the amounts are received, and the market rate of interest. We're going to look at what's known as the present value of the amounts we receive and how long would it take us to receive these different amounts. Okay? Now remember the time value of money concept. The $1 million received in 2017 doesn't have the same value if received in 2037 because of inflation. because prices are going to increase for the most part. So we have to look at with these bonds, they can be a form of long-term debt. So a bond may be issued in 2017, but not paid back until 2037. So we're saying that the dollar does not have that same value 20 years later. We must determine what is the present value of that dollar. Example, assume that Acropolis Company on 1/27 issued 9% bonds for $100,000. The bonds are due in 5 years. They're going to pay interest annually at the end of each year. To determine the actual value of the bond, we'll look at the present value of the $100,000, the amount to receive 5 years from now, and the present value of the interest payment. So this bond pays interest annually. 9% of $100,000 is $9,000. So we use what we call the time value of money concept. What is the present value of $100,000 received 5 years from now? What is the present value of $9,000 received each year for 5 years? Now to do this, you use what we call the present value tables. You will look up a rate of 9%, a time period of 5 years, and it will help you to calculate the present value of these amounts. Okay? So right now in this textbook, we actually give you these amounts, but we have another chapter that shows you how to calculate these amounts. So this bond has a current market value of $100,000. What does that mean? It means that when this bond is issued, it'll be issued at an amount of $100,000. And we'll go through examples of how bonds are going to be issued. All right. I'm going to skip this. True, true, false, true, true, good. Now, a corporation records bond transaction when it issues a bond, sells it, or redeems the bond, which means it's going to buy the bond back. Or when a bondholder converts their bonds into common stock in the case of a convertible bond. Bonds may be issued at their face value, at a discount, or at a premium. That's important. Bonds may be issued at their face value, at a discount, or at a premium. If they're issued at a discount, they're issued at an amount below their face value. If they're issued at a premium, they're issued at an amount above their face value. Bond prices are quoted as a percentage of their face value. Now I'm going to drink some more water and let you read this over. Let's talk about this information. That is some good water. All right. So, just like there's a stock market, there's also a bond market. And when bonds are put on the market, they're going to be issued, or they're quoted as a percentage of their face value. So remember this. Let's say that we issued a bond in January 2020. At that time, the market value may have been 5%. All right? That bond is still out there 6 months later. But by that time, the market value has changed, or the market rate has changed. It's no longer 5%. It's now 5.2%. What does that mean? That means that bonds that have been issued recently are paying 5.2% issue, but your bond was issued back in January, which is still out there, is only paying 5% interest. If that's the situation, your bond will sell at what's known as a discount because you're paying less interest than your competitors. So in order to make your bond attractive, you must sell your bond at an amount below its actual face value. Now, what if that same bond that you issued in January was paying 5% interest, and now the new current market rate is only 4.5% interest. That means that you're paying a higher rate than your competitors. Your bond was sell what's known as a premium, an amount above its face value, because you're paying more in interest than your competitors. Now, maybe you're saying, well, why don't I just change my interest rate? I'm glad you asked that question. You're not allowed to do that. Remember we said that the bonds have a contractual rate on the bond certificate? That rate is set. You're not allowed to change the rate. Once a bond has been issued, that's the rate. So you're not allowed to keep changing the rate because the market rate has changed. In order to account for the difference in market rate, we sell our bonds at a price either below its face value or at a price above its face value. Okay? For example, we have the DeVore Corporation. They issue 100 5-year bonds. They're paying 10%, so 10% is the contractual interest rate. The bonds have $1,000 face value, and they were issued at 100. Here's the key. They were issued at 100. This 100 means they were issued at 100% of their face value. That means that at this point in time, the market rate of interest is the same as the bond's contractual rate of interest. They're both paying 10% in interest. So this is the journal entry made by the bond issuer, the DeVore Corporation. They would debit cash for $100,000 and they would credit bonds payable. Okay? Now, the company must pay the bondholder interest on an annual basis. They're going to pay the interest in January. But our accounting period ends December 31st. Therefore, we must recognize the amount of interest that has accrued on this bond by the end of the current accounting period. Interest equals principal times rate times time. So the accrued interest will total $10,000 by December 31st. It hasn't been paid just yet, so we owe the interest. You would debit interest expense, credit interest payable in the amount of $10,000. Okay? When we make the actual first interest payment on the 1st of January, we would debit interest payable and then credit our cash account in the amount of $10,000. Okay? If you hear some noise, I'm trying to eat my Nutri-Grain bar because I'm getting hungry. Now, as I mentioned before, bonds may be issued at their face value, at a discount, or at a premium. It's contingent upon the bond's contractual interest rate compared to the current market rate of interest. All right? So again, the contractual interest rate stays the same. That rate cannot be changed. But the market interest rate is going to fluctuate all the time. So again, depending upon when your bonds are sold, your bonds may sell at their face value, a discount, or at a premium. It depends upon the contractual interest rate at that point in time compared to the market interest rate. So if the market rate is 8% and the bond rate is 10%, will that bond sell at a discount, premium, or a face value? If the market rate is 10% and the bond is paying 10%, what would it sell at? If the market rate is 12% and the bond is paying 10%, will that bond sell at a discount, face value, or premium? Stay tuned for the answer.